What up, HyperChange? Welcome to another episode. Today, I want to do something a little different. We usually don't talk about it. I'm trying to get more into this macroeconomics. I think it's a fascinating topic. The stock market cyclically has like recessions. Like it's always in an uptrend. Like for the last 100 years, the stock market's always in an uptrend, but then it's not like straight. Like it goes like this, you know? And so every 8 to 9 years, there's a big recession, a big pullback. Like, you know, we saw one in 2001 when the internet bubble burst. We saw one in 2008 when the housing bubble burst. So, you know, they give them all these cute little names, but the bottom line is every 7 to 8 years, and that's not like on the dot, but these recessions do occur. And if you do a little bit of quick math, we're about 9 years removed from our last recession. So that's why a lot of people think we're kind of like the clock is ticking on like cyclically, the market should have a recession sometime in the near future. And I buy whatever, like, there could be a recession on the horizon. What I'm trying to get at here is the Federal Reserve is raising interest rates for the first time since the Great Recession, or has been for the past year. And as of this chart, as you can see, in June, we actually hit above 1% as the effective federal funds rate. So the interest rate's been 0 for 8 years. Now they've been steadily climbing. It's above 1%. It's gonna keep climbing. So it's at the point where it's gonna start to have an impact on the economy slowly but surely. And people will say like, oh, there's inflation, there's a good job growth, we don't wanna be behind, so we have to raise rates to keep up. I don't know what goes on behind the scenes of like how to determine when to raise rates, when to determine when to lower. Like there's a million factors that go into that. I'm not gonna pretend like I know what's going on, but I do know that the rate is at 1% when it used to be at 0. And on a higher level, I think this correlates to the valuation of the entire stock market. Money flows like water. It flows to where it can get the highest return. The average price earnings multiple of the S&P 500 is about 15x, which is about a 7.5% yield. 1 over 15 equals 7%. I would love to buy the S&P 500, which is a collection of the 500 biggest businesses in the world, or in the US, and I get a yield on every dollar I put in of 7.5% earnings annually, and maybe that number will grow a little bit. So that looks like a steal if I can get 0%. So that's part of the reason we've seen stocks trade at a higher price earnings multiple now than historically, because there's no other place to get yield. Sure, if interest rates are yielding 5% from the government, then 7.5% doesn't look that great. But if interest rates are yielding 1%, then maybe 5% looks pretty good. And 5%, 1 over like 20 is 5%, so that means a 20 PE ratio is justified in a lower interest rate environment. So there's kind of this weird like seesawing maneuver of the lower interest rates grow, the higher the earnings multiple on the S&P could be justified. Now the opposite will occur, which is when the higher interest rates go, the earnings multiple on the S&P will contract. And so that is why I think it's fascinating to note that interest rates are rising, and this over time, as a continued like loose rule, will lead to contraction in the S&P's earnings multiple. I don't know. I just think this is something to watch. I wanted to make a quick video with you guys, but the important thing to note is that the Federal Reserve is raising interest rates. The last time the Federal Reserve was raising interest rates this much, they started in 2004, consistently raised them to 2006, from about 1% to 5%, and then a year later we have the 08 recession. The last time they raised rates before that was 1999. We went from 4.5 to about 6.5. They stopped raising. 6 months after that, recession. So there's this clear pattern of like raising rates eventually leads to a recession, and what do they do when they're in a recession? Drop rates significantly to kind of make up for it. I don't spend a lot of time on economics, but I do think it's important to note that for the first time in 8 years, there is a notable change in the Federal Reserve's policy, and that is going to slowly trickle out to the rest of the economy. I don't know what to make of it. Maybe you guys do. Maybe you guys can help out. But the bottom line is the Fed is raising rates. That means I believe that will lead to the S&P's earnings multiple to contract. So if we continue to see rates rise, they go to 2, they go to 3%, then the current 18 to 20x ratio that the S&P trades at is probably going to start to look expensive. You could see it normalize down to 15%, and if rates are to 15 times earnings. And so the S&P, I think, is at risk of a big recession if interest rates continue to rise. And so I hate trying to predict recession, things like that, but I think the one catalyst and the one thing you should be watching for as a hint of recession is interest rates, and they're moving now when they haven't for 8 years, and that's something to watch. That's HyperChange. Let me know what you guys think. I'll see you guys next time. Peace.